This is Nightly Business Report with Tyler Matheson and Susie Garrett. Brought to you in part by
TheStreet.com. Up-to-the-minute stock market news and in-depth analysis. Our quant rating service provides objective, independent ratings daily on over 4,300 stocks. Learn more at TheStreet.com/NBR.
On a high note, stocks rally into the close, ending at record highs on the Dow and the S&P, putting a capper on 2013 and huge gains for investors. The Nasdaq up nearly 40%, the S&P its best year since 1997, and the Dow the best since 1995. The January effect. Old man winter may be rough on us, but the first month of the year tends to be kind to investors. Will the same hold true in 2014? And big payoffs. Our market monitor says he has 3 stocks that could get you at least 20% in the year ahead. All that and more for this final day of 2013, December 31st. Good evening and Happy New Year, everyone. Tyler's off tonight. Well, champagne on Wall Street was flowing today as the Dow and the S&P 500 ended the year with another round of new record highs. 2013 will be remembered as the longest bull market winning streak since the 1990s. The Dow posted 52 record closes, and the S&P tacked on 45 new highs. Here's a look at the scorecard for the major averages for this last day of 2013 and for the year. The blue chips jumped 72 points today, reaching 16,576. That's a new milestone. The Nasdaq added 22, closing at a fresh 13-year high, and the S&P rose 7 points to 1848. For the year, the Dow surged 26.5%. The Nasdaq skyrocketed 38%, and the S&P soared almost 30%, its best year since 1995. Looking at the sectors of the S&P, all 10 rose in the past year. Consumer discretionary stocks did the best. They were up an amazing 41%. Now, the biggest winner on the S&P was Netflix. Its stock almost quadrupled, rising 297%. The biggest loser, Newmont Mining. It plunged 50%. Over in the commodities markets, gold lost its glitter in 2013. The precious metal tumbled 28% for the year, closing at $1,201 an ounce. That's its worst year in more than 3 decades. But oil prices rose 7% this year, closing at $98.62 a barrel. So now that we've closed the books on such a sensational year, what's in store as the calendar turns the page to January? As Dominic Chu reports, Wall Street history shows January is usually a good month for the markets.
2013 was a great year for stocks, and if history is any guide, 2014 could at least start off with more positive momentum. The number crunchers at Bespoke Investment Group found that over the last 100 years, the Dow has averaged a gain of over 1% in January and is positive nearly 2 out of every 3 years. Paul Hickey of Bespoke says the numbers are even more positive if you look at a broader measure of stock performance like the S&P 500.
January is typically a seasonally strong month of the year. In the last 20 years, it hasn't been as positive, but when you look at strong years like we've had, a 25% gain, in prior years where we've seen that, the S&P has actually averaged a gain of about 2.5% with positive returns over 80% of the time.
So, stock bulls like the odds of a positive January. Now, speaking of the S&P 500, we took a look at what sectors tend to have good January runs. During the more recent bull run over the last 3 years, investors have liked the cyclicals, the stocks that are more tied to the ups and downs of the overall economy. On average, over the last 3 Januaries, industrials, financials, and energy stocks have done the best as investors have bet on a recovering U.S. economy. They're all up around 5.5% for the month on average during that time frame. The worst performing sector has been telecom, down around 2%. The question becomes whether investors should even worry about details like this.
We're long-term investors, and so what goes on in any particular week or month is difficult for us to extrapolate from. It probably is a valid trading mechanism, as any momentum-type strategy becomes. And that's really what I think the January effect is about.
In the end, no one really knows what the future holds for stocks, but the bulls are hoping historical patterns repeat themselves this time around. For Nightly Business Report, I'm Dominic Chu.
Another positive for the markets in 2014, the world is getting back to normal. So says Patricia Edwards. She's Managing Director of Investments at U.S. Bank Wealth Management. Patty, we have not heard the word normal in a long time. It's been anything but that. Tell us what you mean by this.
Well, I think if you look at what's been happening over the past 5 years, there's been a heck of a lot of intervention on the parts of governments. We've had overhang from things like the healthcare initiative. And so it really hasn't been a market that's been based necessarily on the fundamentals of the underlying companies. It's been more of a market that's been based on the global macro outlook. And that we think is going to be changing as we go into 2014.
All right, so how should investors look at this new normal world that you're talking about? What should they be doing differently, and what should they be doing the same?
Well, we're looking at the market for next year, and we're thinking that it's going to be a little bit like a B student in an overachieving family. It's going to be a perfectly nice return in the United States, but it's not going to be anything to write home about. 2013 is probably going to have been better. So what we're doing is we are making some tilts within our asset allocation. We're doing some things like overemphasizing international equities and emerging markets equities over U.S. equities, but beyond that, also emphasizing equities in general over fixed income, because fixed income has had a 30-year bull market.
All right, we've been hearing this a lot from many strategists saying time to look outside the United States. As you look at international, as you said, emerging markets, how should investors get into these areas? Is this go into ETFs? Should they go into mutual funds?
Well, it's one of those things where it's very, very difficult to go in and buy individual stocks. So what I think you want to be looking toward, especially in the emerging markets, is someone who has got their hand on the market and is looking over it for you. Certainly, you can use exchange-traded funds, which are usually based on an index, but in a market like this, I think that one of the things that you really want to consider is having a professional manager who can overemphasize Asia if they think that Asia is going to be better than Latin America, or if they think that Turkey is going to be the next hottest market, that they can make those adjustments for you.
And, you know, some of the themes that we've seen over this past year that were so successful were big blue chips, you know, large cap stocks, many of them multinationals that did have a little bit of international exposure. What are going to be the themes for 2014?
Well, I think that you need to be looking at companies that have got that multinational exposure, because that's where the greater growth is. U.S. is growing at about 3%. We think emerging markets, China, are going to be growing greater than that. And so you want to have exposure to those emerging markets. You also want to be looking at companies that do well in an environment where you're in low growth and low inflation. Companies that have good, strong, fortress-like balance sheets with lots of cash on them, that cash can be used not only for growth, but also for dividends and for stock buybacks. You
mentioned that you're overweight stocks and underweight fixed income. Some people still like to have some bonds in their portfolio. What are you recommending?
Absolutely. For most of our investors, we are always going to have some sort of piece of fixed income in the portfolios. But we would be looking toward taking a little bit more credit risk and being neutral in terms of the duration on the portfolio, really kind of having a moderate length of time that the bonds mature in.
All right, Patty, thank you so much. Happy New Year. Hope to see you in the new year.
Happy New Year.
Patricia Edwards from U.S. Bank Wealth Management. Well, investors got their last batch of economic reports for the year, and they were kind of disappointing. First up, housing news. Prices of single-family homes rose in October. The S&P Case-Shiller Index of 20 metro areas gained 13.6% year over year. But on a monthly basis, prices rose less than expected, just a fraction of a percent over the strong September gain. This suggests that higher mortgage rates have slowed home sales. Also slowing business activity this month in the manufacturing-heavy Midwest. The closely watched Chicago Purchasing Managers Index fell to 63 in November. That still indicates some growth, but the new orders segment plunged. But in the same time frame, consumer confidence rose. This is after 2 months of pessimism triggered by the government shutdown. The Conference Board's Consumer Confidence Index notched up 6 points. Well, that shutdown didn't stop new laws from getting passed, so at the stroke of midnight, just like every new year, many of them will go into effect. And in 2014, many of those laws, both state and federal, will have a major effect on low-wage workers and on the individuals and businesses which employ them. Jane Wells explains.
New year, new laws. And beating back the boss attack is at the top of the list. 2014 will see the minimum wage rise in more than a dozen states, led by Washington, Oregon, and California, all at $9 an hour or higher. It will hit the restaurant industry hard.
We've seen things like dollar menus going away by and large, or other increased pressure on the price that the consumer actually is going to end up paying.
Another new law will affect restaurant workers in a different way. Tips, which are often automatically added to the bills of large parties, could disappear because the IRS says if someone is forced to pay a tip, it's not a tip. It's a service charge and should be counted as wages. Restaurants which stick with the practice will have to deduct income taxes, adding to paperwork. So chains like Darden restaurants are phasing out the forced tipping, instead providing a suggested gratuity not on the tip line of the bill.
It came out of a concern that servers in the restaurant industry weren't accurately reporting all of their tips. But instead of the IRS going and dealing with this directly to the servers, they ended up putting this burden on the employer, the restaurant itself.
When it comes to new laws, California always takes the cake. And in 2014, the Golden State is ushering in new laws that include things like mandatory overtime pay for many live-in nannies and maids, or extending paid family leave to include taking care of a sick grandparent or grandchild, sibling, or in-law. Finally, back to food. California will up its farm worker protections. One new law will punish employers who threaten to report a worker to immigration authorities for complaining about substandard pay. And while farm workers already have state-mandated meal and rest periods, they will now also have heat recovery periods of at least 5 minutes as needed in the shade. Add it all up, and 2014 will make life better for those at the bottom, but as always, at a price. For Nightly Business Report, Jane Wells, Los Angeles.
More headaches for Target. The retailer, still reeling from the massive holiday hack of credit and debit cards, confirmed today that some of its gift cards were not fully activated and contain no value. Target hasn't said how many gift cards were involved, but a spokeswoman says it's less than 0.1% of the holiday total. Target says all the cards will still be honored. And coming up, our market monitor has 3 dividend plays he says you should have in your portfolio in 2014. But first, here's a look at how some of the international markets fare today and for the year. '14 is shaping up to be a big year for tech hiring. Global IT spending will grow 5% next year to more than $2 trillion. That's according to IDC. Here's Josh Lipton with a look at the high-tech job forecast.
If you have a degree in computer science or electrical engineering, then there might be a job waiting for you in the new year. Tech employers are feeling more confident about adding new employees to their payrolls, and competition for the top engineers is intense. Dice.com, a tech job site, recently conducted a survey of tech-focused hiring managers and recruiters. 3 out of 4 say they plan to hire more tech pros in the 6 months ahead. And there seems to be more security in the workplace when it comes to tech. Most hiring managers aren't planning on any new layoffs. Catherine Ulrich, an executive recruiter specializing in Silicon Valley, expects to see a lot of demand for those with expertise in cloud computing and data analytics.
Everybody needs to figure out what's their strategy for putting data and applications in the cloud, and how do we use big data and data analytics. How do we figure this out? Do we need to do hiring in that space?
Ulrich says demand is also coming from Asian-based companies, Chinese, Japanese, and Korean firms setting up in Silicon Valley and looking for new sales and marketing talent. If you do get hired in tech, then you can expect to get paid relatively well, according to Robert Half, the staffing firm. U.S. starting salaries are projected to increase an average of more than 3.5% next year for professional jobs. But technology positions are expected to see the largest gains, with about a 5.5% increase in the average salary for newly hired workers. Technical engineers, software developers, and mobile application developers could also see big bumps in their paychecks. And at the top tech companies like Apple, Google, and Facebook, bonuses are being paid to the best and brightest, and that's pushing salaries at startup ventures even higher. Josh Lipton, Nightly Business Report, Silicon Valley.
Netflix is ending its big year by giving CEO Reed Hastings a fat raise and possibly upping prices. And that's where we begin tonight's market focus. Netflix shares almost quadrupled for this year, making it the top performing stock in the S&P 500 index. That performance landed Hastings a 50% salary increase for 2014, according to an SEC filing. Now, the video streaming service is also experimenting with a new model that makes you pay more depending on how many screens you watch on. On top of that, Netflix is ending its poison pill or shareholder rights plan 2 years early. It adopted the plan to protect itself from a takeover when activist investor Carl Icahn took a huge position in the company. Today, the stock was up a fraction to $368.17. Now, last night, we told you that Hertz adopted a shareholder rights plan to protect itself from a possible takeover. Today, activist investor Dan Loeb's Third Point Capital revealed that it has taken a stake of about 5% in the car rental company. Now, the shareholder rights plan at Hertz will only be activated if a person or group acquires 10% or more of the company's stock. Hertz also said that it's held discussions with other investors, including Corvex, about enhancing shareholder value. That news sent shares up almost 10.5% to $28.62. Some merger buzz about Marvell Technology as well today. Private equity firm KKR has reported a 6.8% stake in the chip maker. The firm said it may talk to Marvell about a potential merger or reorganization of its business. The stock jumped 4.5% to $14.38. Warren Buffett's Berkshire Hathaway is swapping around $1.4 billion in shares of Phillips 66 for ownership of one of Phillips' businesses. The unit Berkshire is acquiring makes chemicals designed to increase flow in energy pipelines. Shares of Phillips 66 rose 3% to $77 and change. Shares of Berkshire Hathaway were also up a fraction to $118.56. Hewlett-Packard is cutting 34,000 jobs by the end of next year. That's 5,000 more than the company originally estimated when HP first announced the layoff plan in 2012. The company did say the cuts could increase. Shares were off a fraction to $27.98. And Revlon also cutting costs. The cosmetics company is leaving China and reducing its workforce by 20%. It's all part of a plan to slash costs by about $11 million a year. The move comes as Revlon sales have dropped in its Asia-Pacific market. Shares rose today, though, more than 1.5% to $24.96. Our Market Monitor guest says investors shouldn't assume that stocks will be just so-so in the new year just because 2013 was such a phenomenal year. He's Chuck Carlson, CEO at Horizon Investment Services. Chuck, Happy New Year. Thanks for joining us.
Thank you for having me.
All right, so you say that there are some bullish factors that investors should consider so that they realize that this could be a pretty good year in 2014. Tell us what they are.
Well, first off, our firm looks at a tool called the Dow Theory to discern the market's primary trend. And the Dow Theory is firmly in the bullish camp. We've had a continued series of new highs in both the Dow Industrials and the Dow Transports, which is perfect under the Dow Theory. So that's bullish. Second, the three major engines of the stock market, in my opinion, are interest rates, inflation, and corporate profits. And I think all three of those things will remain net bullish for stocks in 2014. And then finally, while people are getting interested in the stock market again, we still don't see the type of over-the-top enthusiasm for stocks that you typically see at market tops. People are still fairly skittish, and you'll see that skittishness on any type of decline in the market. So those things add up to a pretty good year in 2014. Probably not as good as 2013, but it wouldn't be surprising to see a 12 to 15% gain in the major averages in 2014.
All right, and you've given us a couple of stocks that you think will do well, maybe up by 20% or more, that investors, if they put new money in now. Let's go down your list, and you have Apple at the very top. This is always a controversial stock in terms of the bulls and the bears. Why do you like it?
Well, we like it because it fits the theme of where you can buy growth and buy it at reasonable prices, and Apple really fits that. They're going to have easier comps in 2014 in terms of their earnings, so their earnings are going to grow. We're seeing, better business now as they're expanding in China. You can buy that growth at less than 13 times the 2014 estimate. Plus, you get a kicker and a 2.2% dividend yield. Apple boosted its dividend 15% this year, and I think you'll see at least that in 2014.
All right, so it's at $560 now. Do you have a target on it?
Well, we typically don't do targets, but I wouldn't be surprised to see that stock move at around $650, $660 in 2014.
Your next stop is benefiting from the whole boom in energy, Helmerich and Payne. It's trading around $83. Why do you like this one?
They have a real nice technological advantage in terms of horizontal drilling. They have about 300 plus land drilling rigs that are in high demand right now. Also, a nice dividend kicker, 3% dividend yield. They've rapidly increased their dividend this year. It's gone from 7 cents per share per quarter up to 62.5 cents in about 12 months' time. And I think you're going to see the dividend continue to grow. Again, I can buy that growth at less than 15 times earnings. So again, a good story, growth at a reasonable price. And
your third pick is in the financials, Capital One. Tell us about that.
Yeah, I like the stock. Most people know it for its credit card business. The reality is Capital One is one of the 10 largest banks in the U.S., and I like that blend of banking with other financial services. I can buy the stock at 11 times 2014 earnings estimates, so it's certainly cheap. I get that dividend yield. It's 1.6%. The dividend has grown in 2013 from 5 cents per share quarterly up to 30 cents. So you're going to see that dividend continue to grow at a pretty rapid rate in 2014.
All right, terrific. Any disclosures to make, Chuck?
Yes, our clients own them as well as I own the stocks too.
Okay. Well, Happy New Year again. Thanks for coming on the program.
Happy New Year to you.
Chuck Carlson, CEO at Horizon Investment Services. And coming up next, arguably the biggest difference maker this year to the financial markets. One guess. And finally tonight, we've been profiling all week some of the people who were the difference makers in the world of business and finance. It's safe to say no individual had more influence on the stock and bond markets than Ben Bernanke. And the Federal Reserve Chairman kept market mavens guessing all year on when he would begin tapering the bond buying, which helped fuel the bull market. Here's Steve Leisman with more on Ben Bernanke.
For most of the second half of 2013, Fed Chairman Ben Bernanke sang a single tune, "Don't fear the taper." But it wasn't always well received on Wall Street. He first warned in May of a possible reduction to the Fed's bond buying program known as quantitative easing, or QE.
If we see continued improvement and we have confidence that that is going to be sustained, then we could, in the next few meetings, we could take a step down in our pace of purchases.
The Dow Jones Industrial Average would lose 90 points over the next 2 days and 400 points over the next week. In June, Bernanke spelled out a schedule for ending QE.
We would continue to reduce the pace of purchases in measured steps through the first half of next year, ending purchases around mid-year.
The Dow would shed another 500 points over just 2 days. But after a weak August jobs report and the government on the verge of a shutdown, Bernanke would reverse course.
The committee concluded that the economic data do not yet provide sufficient confirmation of its baseline outlook to warrant such a reduction.
The Dow, up 20% on the year, would rise a percentage point on the day. And then in December, after working all summer and fall to convince markets that tapering wasn't a tightening of interest rates, Bernanke took to the podium for his last press conference as Fed chairman.
Starting in January, we will be purchasing $75 billion of securities a month, reducing purchases of treasuries and mortgage-backed securities by $5 billion each.
The result? The market surged 300 points, and Bernanke finally got his taper in a way that did not spook markets. Over the year, Bernanke and the Federal Open Market Committee ballooned the Fed's balance sheet by more than $1 trillion and helped push up growth from 2% in 2012 to an estimated 2.5% this year. The 10-year benchmark Treasury bond would rise by more than a percentage point, unemployment would decline by 0.8% to 7%, and inflation would remain quiet. What's clear is that Bernanke's decisions made a huge difference this year and will for many years to come as the effects of current policy play out, perhaps through higher growth and lower unemployment, or perhaps also, as some fear, through inflation and a more difficult exit strategy being left to his successor, Janet Yellen. For Nightly Business Report, I'm Steve Leisman.
And that is Nightly Business Report for tonight. I'm Susie Garob. Make sure you tune in tomorrow for our special report, Predictions 2014. But as we go, we want to take you around the globe as the world rings in the new year. And from all of us here at NBR, we want to wish you a very happy new year.
Nightly Business Report has been brought to you in part by
TheStreet.com, up-to-the-minute stock market news and in-depth analysis. Our quant rating service provides objective, independent ratings daily on over 4,300 stocks. Learn more at TheStreet.com/NBR.
I'm Susie Garob with the Nightly Business Report News Brief. Champagne was flowing on Wall Street today as the Dow and S&P 500 ended the year with another round of new record highs. 2013 will be remembered as the longest bull market winning streak since the 1990s. The Dow posted 52 record closes and the S&P tacked on 45 new highs. The blue chips jumped 72 points today to 16,576, a new milestone. The Nasdaq added 22, closing at a fresh 13-year high, and the S&P rose 7 points to 1848. More headaches for Target. The retailer has confirmed that some of its holiday gift cards were not fully activated, but Target says all of the cards will be honored. And consumers are feeling more confident these days. A closely watched index jumped 6 points this month. Be sure to tune in to Nightly Business Report right here on your public television station.